Is anything that we heard from China today going to change their appetite for treasuries?
Well, first of all, lots of those charts seem to be going down into the bottom right-hand corner, whether they be swap rates, inflation rates or growth rates. So that sort of tells you it's a global story, all heading into the bottom right-hand corner of the chart. So the demand for treasuries from other countries, China or Japan, for example, doesn't seem to move very much. The real story is the increased domestic buying. Do you know, in the last 12 months, there's been an additional $2 trillion of purchases of bills and notes by domestic investors. That's the answer to the question that people always give me. Who's going to buy all those bonds when the Fed stops buying? Who's going to buy all the bonds when the Treasury has to issue more?
So where do you see yields going?
It's a question
of
demand.
10-year?
Yeah, well, if the price is right, there's no lack of demand. And the thing is the real yield is quite high and positive, right? So to people in Europe or Japan where real yields are deeply negative, the US positive real yield looks interesting at a time when, in fact, the break-even's below the Fed's target. That takes people into tips, for example. I mean, you can see a lot of that. But the US 10-year yield, which I'm no doubt you're going to ask me about, seems to be stuck in a range, and it's floored by the level of IOER. Which is 2.4, and it's capped by what's going on in China. China's response to the growth challenges, monetary and fiscal. It's capped by the demand from outside through cross-currency basis. People in Europe and Japan are buying treasuries at certain levels. So we're in a sort of 240, 290 range.
Steve, what is so interesting here, and really HSBC folks, is at an incredible 90 days, even 100 days, between Mr. Major's call for lower yields and Ben Laidler's double-digit call for up equity markets in the United States. And Steve Major, how do you feel right now out of consensus? Are people catching up with you, or do you feel lonely still, looking for 2.5% a zillion years out?
Well, I think you can probably see on the Bloomberg consensus forecast, Tom, it'd be interesting to see what those numbers are. Last year, there were 62 forecasts, and only 2 of them had a number below 3%. This year, I think if we reran the chart, you'd see the majority of people are below 3. Many of them might be clustered around the current spot level. 2.5% for US 10s when it's currently 270 doesn't seem like an aggressive forecast. So in answer to the question, Tom, it doesn't feel particularly out of consensus. It feels a bit boring,
right.
which is why my focus is now on curve, swap spreads, inflation linked, relative value, that kind of thing.
Well, then I want to link back to China here without getting into the details on China and government initiatives as well. Mr. Major, could you please focus on the linkages of China slowdown or EU slowdown into these dampened rates? Is it just rates and disinflation getting out in front of weaker GDP? Is it that simple?
Well, no, you're so right to point out the global interlinkages, and I think this is where the mainstream forecast has been lacking content. China PPI tends to lead global inflation. Just look at a chart of that. Chinese yields, the 5-year swap fell from 4% to below 3% in the last 12 months. The biggest story in fixed income was that, but no one was talking about it. That matters. It puts a cap on US yields. The whole China story is, of course, completely interlinked, and I think that the only way you can come to the sort of conclusions we have of low for longer is by incorporating the second biggest economy in the world into the framework. So what they are doing is contributing to the downward pressure on yields outside the country.
Steven, I particularly like your note, actually, because it's always very clear, and you lay out the kind of the 10 big concerns. When it comes to neutral rates, what would make you change that view?
Well, it looks like we will be looking to revise downwards over time. So you're talking about neutral rates. It could be equilibrium rates or the long-term dot and all of this. And Larry Dyer and the team in New York have figured out that it's not going to take very much of a shift to get the 2019, 2020 dots to drop. So it's about the median number. How many people need to change their mind? Well, not very many. One would do the trick. To make a meaningful shift to 2020, you need 3 to change their mind. That doesn't seem unreasonable, given the fact that the Fed seems to have stopped hiking, and we're starting to look along the other side now.
Okay, but the market is also pricing in the possibility of a rate cut.
Yeah.
How improbable is that?
Well, the complexity, I don't want to filibuster you, but the complexity is
go for it.
They've got to stop shrinking the balance sheet first. And so let's just assume that's happening by Q3.
Yeah.
They can't cut rates whilst they're shrinking the balance sheet, unless I've missed something, right? It'd just be a contradiction. So the earliest is really 2020. Yeah, there's also the possibility that if they were to ease, that they wouldn't do it in the conventional way. Why would we assume that they're going to cut rates first and do QE4 later? Why would we assume that the Fed might not twist its balance sheet? There's so many things we don't know.
Right.
So I'm a bit long of don't know, which is why 250 is the 10-year forecast for year end, because I can't really see how we get below.
You know, Steve, to be honest, it was Bloomberg Surveillance, but one of the names before that was Bloomberg. I don't know. We were really lobbying for that name. Steve, help me with the Fed's balance sheet. You've done a lot of writing, a lot of thinking about the balance sheet. Should our viewers and listeners be concerned with the dreaded QT?
Yeah, they should be concerned about the balance sheet, and they should focus on the liability side from the Fed's perspective. It's the amount of excess reserves in the system, how much liquid asset do the banks need, because the banks face off against the Fed, and it seems to us that that's the defining feature. How far can they shrink the reserves? And it's probably not that far from here. The other point I would make is that QT is completely different to QE. We need to be thinking about exponential discount factors. What I'm saying is each $100 billion of QT from here is potentially more powerful than the previous one. With QE, it was the opposite. You call it diminishing marginal utility, if you like. So on the way out, it's proving to be quite powerful. Then there's the question of the multipliers from one region to another. We can't assume that 100 billion US dollars is the same as that created by the ECB or PBOC. It's not the same. So it's fiddly and complex, and the Fed owes us an explanation.